Global stocks dismissing steep losses in China's stocks on Thursday. And we're rounding out fourth quarter earnings season with consumer giant Best Buy. For more, let's bring in Stewart Warther, a U.S. equity and derivative strategist at BNP Paribas, joining me now on set. So Stewart, Best Buy reporting a better than expected quarter, a beat on the bottom line, a slight beat on the top line, but comparable store sales down 1.8%, not exactly an endorsement of the state of the consumer.
Yeah, so I would say that with the consumer, originally, the consumer had been saving much of the gas gains from lower oil prices. And we really haven't, in 2015 at least, see that flow through to personal consumption, except for Q4, which was actually quite strong. However, I do think that some of the recent market volatility is going to be difficult for the consumer. We've seen a weakening of consumer confidence, but at the end of the day, the continuance of these low gas prices, the continuance of perhaps a more dovish Fed should lead to higher consumer confidence and be generally positive for the sector going forward.
Right. I mean, maybe they're watching their 401ks and they're sort of going to scale back spending on worries about that. You mentioned oil. Let's talk about oil prices. I mean, would you agree that oil prices are going nowhere anytime soon?
Yeah, so we actually see a floor somewhere around 30, a leaky floor, albeit, given the fact that below that price, really it's not economically viable for most producers. However, on the upside, there really isn't a positive catalyst, a sharp positive catalyst at least, given that production cuts have been slower than many have expected. So we actually expect some of the lower cost marginal producers, such as Iran, to actually increase production in 2016, given that sanctions have been lifted, which is going to at least offset some of the declines we might see in, say, U.S. shale oil.
So if oil is going nowhere and maybe even down further, I mean, what does that mean for stocks? They've been moving in this lockstep pattern.
Of course. So I really think there's some resolution needed, at least between stocks, the Fed, and oil. We've seen a lot of Fed commentators actually come out recently and been more dovish, and we've actually lowered our Fed hike forecast to 0 hikes for 2016 and 17.
So, and 17.
And 17. So I think recent market volatility has actually provided or taken away the window for the Fed to hike. And going forward, the economy is really going to grow back at trend. So if the economy is at trend, wage gains actually slow down somewhat, you're not going to see a reason for the Fed to hike. But if we do get some clarity, at least around the March meeting, then I think the rest of the stock market is going to react positively, at least to a more dovish scenario.
But do you think the Fed has made up their mind on pausing rate hikes for the next 2 years?
Absolutely not. And I think really they're going to look at the February non-farm payrolls as kind of the last key indicator. And then going forward, they're likely to be, at least maintain the rhetoric that they are data dependent, and we'll really get more of an insight as to how they are thinking as far as their expectations when we see their summary of economic projections in the March meeting.
All right, going forward, where are you putting money to work? What sectors are you looking at?
Yeah, so I still think the utility sector, given that it has rallied so much as a bond proxy, is somewhat overvalued, and especially relative to their own bond yields. Utilities are actually quite rich. On the other side, I think that a more dovish Fed will actually lead to declines in the dollar and a better scenario for especially tech earnings, which have large foreign revenues.
All right, Stewart Warther from BNP Paribas. We'll be watching. Thanks so much for coming by.
Thanks, Scott. I appreciate it.
I'm Scott Gamm, and you're watching The Street.